Hello, happy Friday. It is, as Andrew Keane would say, January the 14th. And this week we are doing the show without Andrew. And we have an interesting show. It's a shame Andrew's traveling, although I'm sure he's having great fun in Costa Rica, where he's on vacation. Here we are. That was the week, number 292, the third show in 2022. Moxie has Moxie. Will the real Web3 please stand up? And you are forgiven if you find this a little bit obscure, especially compared to what we normally talk about here on the show. So let's get into it and talk about it. So this is Moxie Marlinspike. Yet you may have guessed that is probably not his real name, although who knows. Moxie was until this week, the CEO of the private messaging app called Signal. And he wrote a really, really well read and well discussed essay about Web3 on his blog, First Impressions of Web3. And almost everybody who is anybody in Web3 read and commented on this. And mostly favorably, it should be said. In my editorial this week, I quote some of what was said, and I'll kind of paraphrase it for you. Web3, of course, is an acronym, or not an acronym, a shorthand for the next version of technology as seen by its followers. And it's characterized by a few things. Firstly, it is meant to be a distributed infrastructure not owned by any single party, where anyone can show up with a server and contribute to an effort and get rewarded for doing so. The second is it's trustless. That is to say, you don't have to trust somebody in a transaction, because you can trust that the network is doing everything required, the network and the software, so that you can be sure that everything that you want to happen will actually happen, and you won't lose anything in the process. And and that is, those two things are the essence of Web3. There's also lots to do with DAOs and automation, and the ability to be not erased, so the record of what happened stays constant, and you can go and look it up. So basically, what Moxie does is he questions all of that. He says, the first thing he says is that people don't want to run their own servers. The second thing he says is that writing software should get easier, but it's getting harder because Web3 is really, really complicated with all this new stuff. And then the third thing he says is that because Web3 is based on protocols that are open, that it's going to move much, much more slowly than you would wish. What I say in the editorial is that what he's doing is looking at the world from the point of view of an architect and pointing out how hard it is to build open distributed protocols that become standards for others to build on, and that it is much easier to build wholly owned applications and services like we did in Web 2. So that's kind of the essence of what Moxie is saying. So let's just stand back and ask ourselves some questions. So the first thing is, of course, looked at from the point of view of a software developer, Mr. Marlinspike, not his real name, is entirely right. Of course, it's really hard to build protocols. Of course, protocols, because they're standards based and have to stay permanent and constant, move slowly. And of course, developing them is hard. It's also true that once they're distributed and everybody needs to contribute, it'll move even more slowly still, for the most part. And nothing he said is really that controversial, and was true in Web 1 and in Web 2. If you think about Web 1, and let's say that Web 1 was the early browsers sitting on top of the protocols that were then in place, invented by people like Vint Cerf and Bob Kahn. Those protocols, we know the names today: TCP/IP, DNS, email, SMTP, and POP3. an IMAP, for example. So, there's Web 1 had lots and lots of protocols that made up what today we think of as the internet. Web 2 also had infrastructure elements that you could rely on and depend on. So, for example, the rise of data centers, the growth of XML, the rise of JSON as a format to pass data from A to B and so on. All of those things were required, not to mention JavaScript and Java itself, were required for Web 2 to exist. And only because all those things existed could someone like Moxie build software on top of them. And that's certainly been true in the mobile era, where Java is at the core of the Android operating system, and Apple's initially C and now with its new coding language makes it possible for developers to build apps for Android and for iOS and so on. So Moxie is right. Web 3 in that sense is, it's the same as Web 2 and Web 1 in that infrastructure is really, really important. And infrastructure moves slow, and infrastructure requires lots of people to cooperate with each other in order that you can write stuff on top of it. And it's certainly true that it's much faster to write stuff on top of existing infrastructure or new infrastructure than it is to build the infrastructure itself. So nothing remarkable in what he says, except for the fact that he says these things as an argument against Web 3, not really against it's not that he doesn't believe that Web 3 would be a good thing if it existed, but he argues it doesn't exist yet. And his main argument as to why it doesn't exist is because, for the most part, he's living in the world of people who build products and services. And for them, they're building centralized stuff on top of the underlying infrastructure, the blockchain, for example, or blockchains. He points out examples like OpenSea, which is clearly an application very like a Web 2 application, except it's built on top of Web 3. And he shows how both you can't trust OpenSea, and the OpenSea isn't distributed, and the OpenSea is centralized. And all of that is correct, just as Salesforce is all of those things on top of Web 2, or Yahoo was on top of Web 1, for that matter. So he's describing accurately, what is happening, but he's using it as an argument against the thing itself, against the evolution of the network from what we think of as Web 2 to what we're starting to call Web 3. And that's where he and I part ways, and I disagree with him. It isn't that dissimilar, actually, from the argument that is being had between Jack Dorsey and Marc Andreessen. And, just to think about that for a second, Jack Dorsey is saying Web 3 is centralized and Web 3 isn't truly distributed. And Marc Andreessen blocked him as a result of that, because Marc is investing in companies that are trying to build Web 3. Now, the fact is, it really depends from what point of view you're looking at it. If you're looking at it from the point of view of an architect of Web 3, then it's fully distributed, it's fully trustless, and people can build on top of it. And you can rely on certain protocols not going away. For example, you can probably rely on the scripting language for Ethereum that creates smart contracts not going away. And you can probably rely on Ethereum itself not going away. Same with Bitcoin, and lots of other things. So, when people argue that Web 3 doesn't exist yet, or it's centralized, they're really focused on the application or the services layer of what's being built on top of Web 3. They're not focused on the underlying infrastructure. Now, if they did focus on the underlying infrastructure, they'd realize there's a massive difference between Web 3 and Web 2. With Web 3, the providers of infrastructure are rewarded both for their invention and for the deployment of that infrastructure insofar as people cooperate and deploy, for example, mining nodes in Bitcoin, or validating nodes on other blockchains. And so the reward structure being built into the provision of the infrastructure is entirely new. And because it's a distributed infrastructure that requires people to participate, it's really important that reward does flow to those who provide infrastructure. Imagine, if you will, that in Web 1, Vince Cerf and Bob Kahn could have built a token-based reward into TCP/IP such that the founders and inventors were rewarded every time it was used. Today, they'd be very wealthy people. As it is, neither is wealthy despite their massive contribution. Same with Tim Berners-Lee. If he could have built into HTTP and HTML that the inventors were rewarded as it was deployed, he would be a very wealthy man, and he is not a very wealthy man. Web3 is really different. Invention and deployment are rewarded at the level of the protocols and the architecture themselves. And so when you build something on top of Web3, you are helping reward the inventors of the underlying infrastructure. And for that reason, infrastructure will not move as slowly as Moxie believes. Reward systems tend to accelerate everything, including decision making. And so what am I saying? I'm saying that Moxie is accurately describing the world from his point of view, just like the blind Indian who stands at the front of an elephant describes a trunk, but not an elephant. Jack Dorsey is describing what he sees to be true, also with the mindset of a developer, building applications and services, but contributing to the underlying distributed architecture as well. And Mark Andreessen is right to not accept that Web3 is centralized, as he's investing in and helping build a fully distributed new platform that software and services can sit on top of. So it depends on your point of view. And this argument really is not something that should be taken too seriously. My original title for the newsletter this week was Moxie is wrong, and worse still, irrelevant. I decided that was a bit too aggressive because he isn't really wrong from his point of view. And I changed it to Moxie has Moxie, acknowledging that he certainly had to have cojones to write what he wrote. And then, subtitled, will the real Web3 please stand up? And I think the real Web3 is standing up and is being built as we speak here today. So that is the first part of this week's newsletter. The second part focuses on the changing face of venture capital. And there's a lot in the curated articles. First thing to note this week is that Y Combinator announced that its standard deal is being upgraded. Instead of $150,000 being given to a company for 7% ownership, there will now be two tranches of capital, an initial tranche and then a second tranche, in total $500,000. Jeff Ralston announced this whilst also hinting that the number of companies in the YC batch that is forthcoming, is currently under operation, is a much bigger number of companies. So Y Combinator is definitely contributing to the startup ecosystem at an accelerating and expanding rate. That led the information to headline that seed investors are starting to fear due to this $125,000, $375,000 split, because why will you need a seed investor if you're already going to get $500,000 from Y Combinator? And I think myself that is a misnomer. I don't think seed investors need to be worried. In fact, they should be applauding Y Combinator doing this, especially at the scale they do it. And there are going to be, let's say maybe 10% of the Y Combinator companies will be attractive to the seed investors who can write checks much bigger than $500,000, and there are lots of those. So there's lots of coverage of that. There's also coverage of Sequoia Capital, which we've mentioned before. Sequoia has now formally changed its regulatory status and is no longer a venture capital fund in the simple sense that it used to be before. And it is basically restructuring itself with a top co sitting on top of it. And it is an investment advisor from a legal point of view, a registered investment advisor or an RIA. So lots to talk about there. Andreessen Horowitz, it's interesting because it was announced that Tiger Global is now investing roughly $1 billion a month in companies around the world. Andreessen Horowitz announced a $9 billion fund, 3 funds actually, a total of $9 billion. And, there would have been a time when that was, you would gasp that much money was being raised by a single firm, even across 3 funds. But in comparison to Tiger Global, which is putting more than that to work every year, things start to come into context. And the dialogue we've had here on That Was the Week about the asset classes in venture, the seed asset class, the venture asset class, and the growth asset class. And we've discussed how the growth asset class is moving into the turf previously inhabited by the venture funds, doing A rounds, B rounds, for example. That is a reality. Y Combinator is pumping money in at one end, and Tiger Global is pumping money into the best of those companies at the other end. And there isn't, a whole lot of space in the middle unless you really figure out your role there. And I think that is going to be a constant theme this year. Startup of the week, just to stick to the theme, is Texas Pacific Group, or TPG as it's now known. TPG is making the bold step of joining others. The Financial Times has a list of them here showing their progress, their market value in billions. It's going public. TPG is going public, and it's joining Blackstone, Brookfield, KKR, the Partners Group, Apollo Global, EQT, 3i, and many others, Carlyle, that have gone public. And these lines show the value growth over time between January 2000, January the 1st and December the 31st, 2021. Showing that valuations of publicly listed asset managers have been rising. And I included the S1 filing from TPG because it has some fascinating data about how they operate. So TPG is this week's company startup of the week, not that it's really a startup. And we'll end on Chris McCann's tweet, which was part of the aftermath of Moxie having Moxie, where Chris McCann tweeted 8 reasons why Web2 VCs are NGMI. NGMI, any guesses? Stands for not going to make it. And it comes from the Web3 world. And he has a thread on Twitter, which I linked to, which is his explanation about why Web3 venture is going to beat Web2 venture. And Chris is an astute observer. He's a partner at Race Capital. He's a seed investor. He's one of the investors in FTX, which is a really fast-growing blockchain Web3 company, and previously was at Greylock as a venture capitalist. So he's a man who you can assume his point of view is educated. So that is this week's That Was the Week. We've been doing this for 20 minutes now without Andrew, so pat on the back for me. And I hope you enjoy the newsletter. I hope you enjoy reading the curated articles and think they're relevant. And if this week it feels a little bit obscure to you, welcome to the party. I think it probably feels obscure to everybody except for the small number of people that are focused on Web3, one of which is me. Thank you. See you all next week, and happy weekend.